In this lesson, we will look at the general framework of a financial due diligence report. Measuring earnings quality. The calibration of earnings quality is vital for gauging a company's sustainable performance and intrinsic value. It's the magnifying glass through which the true economic substance of a company's profits is viewed, devoid of accounting obfuscation or one-time distortions. The measure of earnings quality is therefore essential not only for understanding past performance, but also for projecting future profitability and guiding intrinsic valuation. In dissecting earnings quality, analysts meticulously scrutinize each component of the historical financial statements. They separate the wheat from the chaff, identifying which elements of the reported figures truly represent the repeatable, operational performance of the business. A rigorous methodology underpins this granular analysis. Identification of non-recurring items. You should comb through income statements to spot anomalies. These could be exceptional gains from asset sales, costs from restructuring, or any irregular items that the business would not routinely encounter. Adjustment of operational activities. Review and recalibration of normal operational earnings are performed, which involves normalizing EBITDA to exclude one-time effects and to include overlooked recurring items. Normalization of EBITDA. The identified non-recurring items are mathematically adjusted against the reported EBITDA to yield a normalized figure that is indicative of sustainable earnings. Verification and corroboration. The adjusted EBITDA is then scrutinized against budgeted and historical figures, with discrepancies investigated and rationalized. This step often requires in-depth interviews with financial and operational managers to understand the reasons behind variances. The equation to calculate normalized EBITDA can be as follows. Normalized EBITDA equals reported EBITDA minus one-off gains plus one-time losses minus non-recurring income plus recurring expenses previously capitalized. Now, let's consider this example. A company reports an EBITDA of $100 million. An in-depth analysis revealed the following. A one-off legal settlement that resulted in a gain of £5 million. Extraordinary inventory write-downs totaling £3 million. Non-recurring income from the sale of a subsidiary worth £8 million. Understated recurring maintenance costs that were historically capitalized, now corrected by an increase of £2 million. Then, to obtain a normalized EBITDA, those items are adjusted as follows. Normalized EBITDA equal £100 million, minus £5 million, plus £3 million, minus £8 million, plus £2 million, equaling £92 million. This calculation strips the reported EBITDA of its exceptional items, presenting a figure that more accurately reflects the company's operational profitability. Financial performance projection. The prospective financial projection provides an estimate of a company's future EBITDA and cash flows, which are integral to its valuation. The scope of financial due diligence may sometimes exclude this projection phase. In such instances, the projection may be treated as a separate valuation exercise. Projecting forward-looking EBITDA necessitates a multifaceted approach. Considering historical performance as a foundational benchmark, analysts must dissect past financials, evaluate growth trajectories, review the company's sales strategies, and consider prevailing market conditions. This process extends beyond mere extrapolation, requiring a judicious mix of quantitative analysis and qualitative assessment. The methodology embraces various tools, including trend analysis, ratio comparisons, and financial modeling. For instance, historical performance is critically analyzed to identify patterns and growth rates, which then inform the construction of a predictive model. This model factors in the company's strategic initiatives, such as entry into new markets or product launches, and the broader economic landscape that could influence its performance. Interviews with key personnel, including management, sales leaders, and finance officers, are indispensable to validate assumptions used in the forecast. These conversations delve into the strategic underpinnings of the company's plans, potential operational hurdles, and the competitive environment, all of which significantly influence the financial forecast. At the culmination of this exercise, the projected EBITDA and cash flows become instrumental in valuation methodologies like discounted cash flow and comparable company/transaction analyses. These methods leverage the forecasted figures to gauge the company's worth, taking into account the time value of money and comparing it to similar entities or transactions in the market.